John, thank you for joining us today. We have Jonathan Woloshin, who heads real estate research for UBS Wealth Management's CIO's office. It's a bit of a mouthful, but would love to maybe just start off a little bit by asking what your role there entails and how you see the world from kind of from your perch, or what your role there is.
Absolutely. First of all, thank you very much for having me, Tyler. I appreciate it. And thanks to the entire team. So the Chief Investment Office at UBS is a separate, independent, self-contained research department that is solely for our financial advisors and our individual clients. My role within that is to research the entire U.S. real estate market. That's both public and private. So I cover residential real estate, commercial real estate, and lodging. So I look at all the public companies, the home builders, the REITs, and the hotel companies. But I actually spend a majority of my time looking at the private markets, so really understanding, because real estate is such a hyper-local business, that I spend the majority of my time looking at whether it's market trends, sub-market trends, obviously what's going on in the financing markets and things like that, demographic trends, population flow trends, what's going on. In fact, I'm writing a blog right now on some of Vice President Harris's housing proposals. So I spent a lot of time looking at regulatory proposals and actions at both the state and federal level.
Fascinating. And I many questions come to mind even just with that short introduction, but I think it'd also be great to understand how you came to this role, how you were kind of attracted into the field of economic research, and how you landed where you are today.
So the Reader's Digest version of how I got here was a little bit of a not straight path, if you will. In fact, I told this story to a friend of mine yesterday. From the time I was 5 years old, I thought I was going to be a brain surgeon. And I did all the requisite work one needed to do, including working for one in college. And it was my senior year, and I probably shouldn't say I woke up with a hangover in November of my senior year, but I did. And I had this epiphany that I didn't want to be a doctor. Yeah. And that was the easy part. The hard part was, now what do I do? And so what I had done was I did a little bit of an assessment of, I'd taken all these business classes as fillers for all the science that I had to take. And I found they came quite naturally to me. So I went and talked to the dean of the business school. I went to the University of Rochester, and I said, okay. And I frankly at the time knew nothing about real estate or Wall Street for that matter. And I went to business school. I got a master's in finance and corporate accounting. I am a reformed investment banker. I did that for 6 years. And I've been a securities analyst for the last, 34 now. I didn't specialize in real estate. I looked at my first REIT, I believe it was in 1993, if I remember, but I was still, kind of doing a lot of different sectors. I joined UBS 17 years ago because they needed somebody who understood real estate, but also had a broader background. And that's sort of how I got to where I am. And so for the last 17 years, it has been, a primary focus on real estate.
You mentioned 1993 was first kind of entree into the real estate portion of being an analyst. Interesting times to start looking at real estate.
Yeah. Coming out of the S&L crisis, it certainly wasn't dull, but I'm a big fan of deep end of the pool and trial by fire. So
yeah. I'm curious, since that was kind of where you initially cut your teeth in real estate analysis, what are some takeaways? Because obviously was a very unique moment in time, much like we're dealing with today. But what were some of the takeaways or observations that you reflect on from that particular cycle or period in time?
Yeah, and I think the biggest one was leverage. And what's amazing to me, and I've had the very, very good fortune of being on Wall Street for a long time. I'm celebrating year 40. And what never ceases to amaze me is we talk about cycles, and we talk about the repetition of cycles and the repetition of mistakes. And, clearly it's so easy in hindsight to look back at the S&L crisis and see the plethora of mistakes that were made. Yet, certainly in real estate land, you can point to the housing bubble. You can talk, which led to the global financial crisis. You can talk about the incredibly poor balance sheets many of the REITs had in the period of 2004, 5, and 6, as they were spending money like drunken sailors. But yeah, we repeat a lot of cycles and a lot of mistakes in the investment business. But I think for me, number one is leverage can cut both ways. And there's an appropriate amount of leverage to use in real estate. By nature, it's a leverage intensive business, but it's not just the use of leverage, it's the type of leverage. I tend to, look, real estate is a long duration asset. And I think one of the cardinal mistakes one can make is having a massive asset liability mismatch. And when you finance a long duration asset with short-term floating rate debt, while it won't always get you into trouble, history is not on your side. Let's put it that way.
It almost sounds like you're talking about today.
Well, we can certainly have a little bit of chat about what's going on today. Yeah, absolutely.
Yeah, that is interesting how you tie in both the S&L crisis, then the housing market, and then today, how you tie debt into and debt's role in each of those. And I'd love to hear kind of your perspective on how real estate debt has played a role in where we are today and the current real estate downturn that we're in.
Sure. And, it's like if you go back to the S&L crisis, I mean, look, were there bad actors in the S&L crisis like there are in every cycle? The answer is unarguably yes. But what happens when you have, I don't like the word bubble, when you have an over-enthusiastic
frothy, exactly.
Let's just frothy. That's a great word. When you have a frothy situation, people forget the basics, and and we all make mistakes in this business. I want to be clear, but when you get in a frothy situation, people tend to forget the basics, like lending standards, whether it's debt service coverage ratio, whether it's NOI debt yield, whether it's loan to value. I mean, we can go, credit worthiness, take your pick, whatever it is, and so. I think back to the period, and I'm going to use multifamily as the example, because I think multifamily is a really terrific asset class. But if you look at where we are today, I think 2024 is a very interesting year in multifamily. Some of it is because we have a lot of new capacity coming online, and that's no secret. Everybody knows this. But what I found really interesting was I went back and I ran these numbers. Between 2011 and 2023, there were $2.2 trillion of multifamily deals done in the United States. 53% were done between 2018 and 2022. Of that number, round numbers, 40% were done in the Sun Belt. Now, we all define the Sun Belt a little bit differently. Yeah. I think you get the basic idea. And so, why do I focus on this time frame and these geographies? Well, because a lot of that new capacity is coming in the Sun Belt, number one. Number two, so coming out of the GFC, you had the really sophisticated, private equity folks who said these assets are trading so far below replacement cost, and there's no capital available. This is like akin to shooting fish in a barrel. Yeah. And so we went from 2011 all the way through 2017, 2018, and everything kind of normalized. What happened was, what I call the non-cycle tested, less sophisticated crowd, shall we say, came in and said, this really is shooting fish in a barrel. So interest rates are never going to go up, and rents will grow at 10% forever. And so therefore I can finance short and floating and pay a 3.5 cap or whatever. I'm being a little facetious, but not really. And so it violated, when you think about what are some of the major mistakes you can make in commercial real estate investing. You can buy in the wrong area or buy a bad building, clearly. You can pay too much. You can finance it short. You can finance it floating. In a lot of these cases, they bought in good markets, generally decent assets, but they committed three major sins. They paid way too much, and there were actually four. Way too much. Their assumptions were erroneous on NOI growth, i.e., rent and expenses. And then they financed short and floating. Now, I don't know that anybody who was predicting that we would go from 0 to 5.25 in Fed funds in such a short amount of time. But, this is one of our jobs as analysts. We run scenario analyses and we say, what if? And, I mean, it's just like, I'll go back to long-term capital. Some of your listeners may remember long-term capital. And these were, these were the smartest people in the room. I studied under some of them. Trust me, they were intellectually brilliant. But the issue was with long-term capital that when you stress test something, if your stress bounds are not wide enough, you run the risk of having a multi-standard deviation event. But if you stress it too much, you'll never make an investment. And this is the judgment in the business. And so I think what happened was that you had too many unsophisticated investors in the case of multifamily who said it is a great asset class, and I fully agree with this, but just got too far over their skis and went too far out on the risk curve. So we're sitting here with this sort of very interesting situation. And I look at it, and there are going to be people who disagree with me, and that's fine, and I totally respect that. I'm not saying you have to go out and finance for 20 years, but when you go out and do, 6-month, 1-year, 2-year floating rate debt, when interest rates are flat on their rear end, and all of a sudden, those interest rate caps expire, you had to run that what if scenario and say, at what point am I going to be in trouble? And I think that's sort of where we are today.
Yeah, and to take that a little further along, essentially you're saying that today is when that truth is kind of like coming to reality.
Well, it already has. I mean, you've seen it.
Yeah.
There have been some, like in the popular press, there have been some very, very high profile situations. There was a very, very large complex in San Francisco, a very big syndicator down in Houston. But look, I will tell you this, that, one of the first lessons I learned in finance was separate the difference between operational and financial distress. Although I do not in my heart believe that all office is bad. In fact, some office is doing very, very well. I think it's a reasonable conclusion to say that some office is operationally distressed. Most of multifamily, if we're correct in our view, in terms of what the demographic trends are in the country, the cost of housing, the shortage of housing, we think the backdrop for demand in multifamily is going to be positive going into 25, 26, 27, 28, and so forth. So we're talking more about financial distress. And I think most of your listeners would agree, much easier to fix a bad balance sheet than it is to fix a bad asset in a bad location.
Yeah, I agree entirely. And the only real operational headwind that multifamily has seen is oversupply. You just, and that is also a relatively transitory thing. We're already seeing a large drop in development activity. I'm curious. I forget the phrase exactly, but it's like real estate cycles or market cycles. They don't repeat, but they rhyme.
Yeah.
I'd love to take a twist on that and talk about what would you say is unique or different about this cycle. Again, keeping in mind that broadly speaking, lots of similarities through the cycles. You mentioned the debt, but it'd be interesting to maybe double click down on aspects of this cycle that are a little different or new to us, or we haven't seen that before. Office being one of those, obviously, right. But
And so within the last 30 plus years, we've seen 3 major real estate cycles, including the current one. And in my business, the most dangerous phrase is, it's different this time. But as you correctly point out, every cycle has its differences. So when you had the S&L crisis, private equity was really the leveraged buyout business, and there was really no money that went in, no private equity money that was going into real estate for all intents and purposes. Then you had the global financial crisis, and I remember all the calls I was getting. Where's the RTC? Where's the RTC? I said, well, the RTC is now called private equity. But at that time, and so this is really kind of 2008, 2009, there was virtually no capital available. In fact, I can recall I was at the November 2008 NAREIT conference. It was in San Diego, if I remember. And I mean, these were some of the highest quality REITs out there who were in danger of going BK because they couldn't get access to any capital. So I think one of the key differences today is that there is capital available. I do not want to oversell this. Capital is more expensive, obviously. It's tougher to come by. But if you just look at a few data points, there's been more CMBS debt issued through the end of July than there was in all of 2023. Number one, the REITs are on pace to raise more capital, predominantly in the unsecured debt market, than they raised in all of 2023. Bank lending has been curtailed, but it has not gone to zero. And if you look at, it's a great acronym, it's called the SLOOS. It's the Senior Loan Officer Lending Survey from the Federal Reserve. And they have it for just traditional commercial real estate, for multifamily, and for construction development loans. While it still shows relative tightness, if you look at it over the last, say, 6 quarters, that number has, it's eased significantly. So that's the biggest difference I see. And then in terms of dry powder on the sidelines, the amount of dry powder that has been raised, and some of it has gone to work, so these numbers give me a little lapse in these numbers, is somewhere between $400 and $450 billion of unlevered dry powder just in the hands of private equity. So if you put conservative leverage on that, you're talking upwards of $900 billion of buying power. But what I find more interesting about that, if you really cut the numbers, of that money, something like 13% is in the hands of the top 10 funds in the world. And maybe 20% is in the hands of the top 25 funds in the world. So this has, to me, a couple of interesting implications. Number one, you have very, very sophisticated investors who are charging fees on committed, not drawn capital.
Yep.
So they are not paid to manage cash. That's number one. But number two, because they have to do ever larger deals, this does open up for smaller funds and smaller investors opportunities that may bypass the larger funds for obvious reasons. So those are some of the differences I see. Now, I don't want to be Pollyannish here. There is about $2 trillion in commercial real estate debt that's coming due between 24 and 26. Now, the one thing that I would say to that is, give or take, there's about $920 billion that's supposed to come due in 24. But if I showed you the same chart that I have today, and I showed it to you 6 months ago, that 24 maturity number was more like 500 billion, give or take. And so what happened was, just like we saw in the GFC, the dread tend and extend, blend and extend, call it what you will. And I had many discussion and sometimes heated discussions with clients, with investors, what have you, about, oh, you're just kicking the can down the road. And one of the things I love about real estate investing is it is an asset by asset, deal by deal analysis. And you can look at one building on one side of the street and another building on the other side of the street in the exact same market, and they can have completely different characteristics. And so to me, it makes no sense to foreclose on a building if all we're talking about here is it needs a little more equity, and so we'll extend it, we'll work it out. If somebody tosses the keys back, or if there's just no way this is going to work, okay, I get it. So those are just some of the differences that I see.
Yeah, and like you said earlier, that operational performance is by and large still there. So you're not, what we dealt with a lot in the GFC is where you actually had operational non-performance. And so, those are assets that are very difficult to fix. Mm-hmm. It's interesting. You and I spoke earlier last week, and you had kind of drilled down a little bit on, you mentioned Sunbelt markets earlier on our podcast here, and you had drilled down a little bit on looking at kind of secondary, tertiary markets in the Western U.S., the markets that we look at. One of the things that I thought was interesting about that is it looked like the maybe the supply-demand equilibrium was a little bit better in the smaller markets in the Western U.S. than in the smaller markets kind of in that Sun Belt region. And this is kind of drawing to kind of a larger question or observation is, we've seen that when we look at the transaction volume of commercial real estate over time, the influence of institutional capital is pretty significant. And so I look at like the Southeast. I think everybody and their brother and every institution and their brother said multifamily in the Southeast, this is the gold mine that'll never give up. How do you see that kind of ebb and flow of institutional capital into and out of spaces affecting the supply-demand equilibrium? And also kind of adding on to that a little bit, where do you see opportunities as it relates to that?
Sure. So this was sort of like in the middle of the GFC when, and I'll go back to that NAREIT meeting I went to,
Yeah.
when it was the closest thing to a corporate funeral I ever saw. I mean, there's some stories are probably inappropriate to tell, but let's leave it at. I
Yeah.
saw some very panicked faces.
Yeah.
So when I got back to New York, I said, all right, you can't just sit there and say the world's over. So let's start kind of putting pen to paper here, if you will. So we started trying to tackle the debt, but then we started to tackle, where do things go from here? And so we sort of have done the same analysis as where we are today. And I called it back then, and I call it the same thing today, the Wayne Gretzky approach to real estate investing, which we all know his famous line, I skate to where the puck is going. So one of the things we sat down and thought about was, where are people going and why? And this is one of the reasons we spend so much time looking at not only demographic trends, but looking at regulatory impacts, whether it's tax, whether it's regulations, whether it's and when I talk politics, I'm only talking about policy. That's all I care about. And so, obviously, and I'll leave COVID aside for a second, so you can see, and we have the data, which I think we did send to you last week, about all the movements from certain states to certain localities. And look, some of it clearly is driven by weather. I mean, I suffer no illusions about that, but much of it has been driven by policy. People want, they want to pay less in tax. They want, they want more of a hands-off approach. And so I think that, that has had a lot to do with it. Then you had COVID. And COVID clearly has caused many distortions. No shocking statement there. Some of them are reversing. Like I think you've seen some of the movement into. I think two of the biggest beneficiaries I know were Austin, Texas, and Boise, Idaho. And you have seen some reversal of that. Now, this is not to say either of those are bad markets, but they were two of the biggest markets that benefited from inflows. But I think that, we are living in a world where there has not been a final determination as to hybrid work, whether called work from home, hybrid work, it goes by many, many names. And I think people are still trying to figure it out. But I think one thing that is clear to us is that hybrid work on some level is here to stay, certainly for the foreseeable future. And so as investors, they have to look at, not only the supply side of the equation, but the demand side of the equation, and also risk-adjusted return. And this, to me, and I always like to say this, and I believe I said it to you guys last week, and I want to repeat it for your listeners. I'm an analyst who covers real estate. I'm not a real estate person who became an analyst. And the reason I highlight this in every talk that I do is because there are three things that have never gone out of style in my career. There's no new paradigm. Trust me, I heard that all through the 90s. No new paradigms. Free cash flow, proper underwriting, i.e. what assumptions are you making,
Yep.
whatever it is you're looking at. And the third one is risk-adjusted returns. And so while I think the Phoenix market, or let's call it Maricopa County, I think is an absolutely terrific long-term market, there are certain risks right now with the combination of all the new capacity coming, as well as what are going to be some distressed assets because of what we talked about before. And so I would argue with you right now, the risk level is probably a bit higher. If you look at a market, say Chicago or anywhere in Illinois, they have a very challenged fiscal situation. So I'm not telling you that Chicago is an uninvestable market. What I'm saying is the return you require is got to be higher because of the relative risk. And so I think what you see institutional investors doing, now again, it depends how big an institution. I think it's going to be harder for a very, very large institution. I think we all know the household names to go to some of the secondary and tertiary Western markets we talked about last week. So hence, I think there's great opportunity. But what the beauty of those markets is that the relative cost of living is much better. You still get the geographic benefits of where you are. Now, I think you asked me where do I see some of the really interesting opportunities are actually not in the coast. It's more in the Midwest. And I really do credit President Biden for this. The Chips and Science Act has really, as you know, I don't want to call it a manufacturing renaissance. I want to be clear, but we are seeing a significant number of semiconductor fabrication facilities being built. These are very large, very expensive facilities, which not only create a lot of high-paying jobs, not only the construction jobs, but the jobs afterwards. But when you think about the add-on or derivative impacts of that, and I was really taken by this when I was in North Scottsdale back in January, and I was up where Taiwan Semi is building their $60 billion facility, which, by the way, is a spectacular facility. But what took me more than the facility was when you looked at it, what did you see afterwards? Housing, retail, industrial, storage. So it becomes a virtuous cycle. And so I think as investors, you know, we want to look not only at the direct opportunity, but all the derivative opportunity that comes with it. And so when I look at, you know, Columbus, Ohio is the obvious market that jumps off the page, but there are other Midwestern markets that are getting a lot of science and technology investment. One market that was in Huntsville, Alabama. I was back there, I think in November. Now, I'm not the only one to figure out Huntsville. They're getting probably too much multifamily capacity, but that's a market. Most people, if I said to Huntsville, they'd be like, are you kidding me? They call it Rocket City, by the way. It's a big NASA facility, and the mayor did a talk before our panel spoke. That mayor has done an absolutely unbelievable job of bringing not only business but high quality, high tech business. So those are the things we think you want to look for.
Yeah, that makes a lot of sense. And I know we're getting a little short on time, so want to be cognizant of that. But maybe the last kind of opportunity or last question to leave people with a little bit of opportunity is we have 4 major food groups in real estate, you know, retail, office, industrial, multifamily. We have talking about supply and demand, we have a certain supply of capital that is allocated into real estate. And one of those 4 food groups, the office product, is questioned right now. In the long season of time, it'll resolve itself. But I'm curious, how do you see the opportunity set if you still have the same amount of investable capital that is being deployed to real estate? Where are you seeing the opportunities open up for, you know, other avenues or opportunities, given that office is a little bit off the table right now?
Yeah, and I just want to be clear. I don't want to tell you that office is completely off the table, in the sense that, you know, I've talked to a number of our clients who are going into really good areas, but are looking at office assets that are high quality office assets that were just financed really, really badly. And so banks don't want to own them. And in certain cases, they're able to structure with the lender, you know, whether it's an AB note type structure, what have you, or something along those lines, where they're making the bank their partner, not their adversary. And that allows them to buy the building at an incredibly low basis, sometimes approaching land value, or even less sometimes. That means they don't have to operate it at a 90% occupancy. They don't have to have, you know, total market rents. So I think those opportunities do exist. You know, I think but office is very, very operational and capital intensive. I want to be clear. So we still see, in our view, the best opportunities probably in 3 major food groups. As I said, multifamily, I think there's the demand characteristics over the next several years are very good. Industrial or warehouse, I know there's a lot of talk about oversupply right now. If you look at that supply curve, it's coming down rapidly. And so think about that. And, you know, you want to be looking at markets where you're seeing other economic growth, if you will. And then necessity-based shopping centers. I know there's a lot of concern about the economy and the consumer right now, and understandably so. But what I was really taken by, not only at the data out of ICSC, the International Council of Shopping Centers, back in May, but we just went through earnings season, and not only the numbers, but the tone coming out of the shopping center owners who own these necessity-based shopping centers was really astounding. And so I think there's really good opportunity for people who are comfortable going into secondary and tertiary markets where the cap rate differentials between a primary market and a secondary and tertiary market can be north of 300 basis points. So that gives you a fair amount of margin.
Plenty of cushion, yeah.
Yeah.
That makes a lot of sense. I'll close out with this, which is rewind back to your younger self when you were first getting started. What would be a word of wisdom you would give to that younger self?
It's funny, I was asked this question not too long ago. Knowing everything I know now, I would have gone right into the commercial real estate business. As much as I love Wall Street, and I do, I would have gone right into the commercial real estate business. Beyond that, I actually did have this conversation with a younger person not too long ago, and it's sort of like, I use a lot of movie references, and the best movie reference I have here, for anybody who saw The Karate Kid Part 2, there was this famous scene where they go to Mr. Miyagi's home dojo, and he has two signs, all written in I guess it's Japanese, and he translated. He goes, "Rule number 1, karate for defense only. Rule number 2, go back to rule number 1." And for me, what that says is there is no new paradigm. During the 90s, what did we hear? It's a new paradigm. Valuation doesn't matter. Baloney.
Yep.
It does matter. Go back to rule number 1. Risk-adjusted return, proper underwriting, free cash flow. Go back to the basics. Every one of us will make mistakes. Every one of us will get caught up in that frenzy occasionally, including, unfortunately, me. I've made those mistakes. But go back to rule number 1. I work for a brilliant guy, and he said something to me once when I showed him an investment. And I said to him, I said, something doesn't feel right. And he said to me something really basic. He goes, if it doesn't pass the smell test, it's telling you something. And that was amongst the best advice I ever got as a young analyst.
Well, I just want to thank you for taking the time today. This has been super insightful. I hope some of our listeners will enjoy this as well when we publish it. But thank you for taking the time.
My pleasure. Thank you for having me. Happy to chat anytime.
All right. Thanks.
Take care. Bye-bye.